In any case, I quite often will show a correlation. I have one free chart at the beginning of this report. If you can go back to the beginning of the charts, the first page of the chart pages, just before this, there we go. This is a picture of the Japanese yen against the Nikkei. Very interesting situation. And in fact, if you can just move down there. As you can see, there's a very strong inverse correlation. As the yen gets stronger, the Nikkei falls. But in recent months, we have, as you can see from those two lines there that are creating the X, we have an inverse relationship, which is very strange, and it may tell us something about why the Japanese have not, in fact, intervened again. If the Nikkei had continued to fall, they might have intervened again, because to tell you the truth, the stock market is as important to them as their exporters' ability to sell based on a weak currency. So this is just a little observation. It doesn't necessarily call for any action on your part, but it's something you might want to observe. As a general rule, as the yen gets stronger, the Nikkei gets weaker, and vice versa. And now we don't have that happening here. So it's just something to take notice of. And again, this is part of this whole comprehensive overview that you really should have in the market. Now, if you can move to another chart, really any chart. This is the one that I said we had a new signal on it at the beginning of talking about this report, which was a little bit unusual to have the euro-yen lead euro-dollar. But you could see it happening already yesterday with that big black bar, and then today, and now again, this is this is the price as of the close yesterday, where he's got the cursor right now. And let's just note a couple of very simple things. One of the things I always say is that technical analysis is actually pretty easy. What's hard is trading. Applying it is what's hard. Doing it is pretty easy. And if you're methodical and consistent, you can always know pretty much what the next move is going to be. Now, in this instance, we had yesterday or the day before, we had the close right at that red squiggly line, which is the 20-day moving average, and right at it. And that is always significant. For some reason, nobody will admit it in foreign exchange, but it has been my observation over many years that, in fact, it is a significant number. And it's significant not only for the daily price charts, but for other periods. One of the periods I like to use, and something that we probably won't have time to show you, is the 360-minute, which is 6 hours. The 6-hour chart that is a very good chart to use for trading purposes. And the 20-period moving average on the 6-hour chart is just as valid as the 20-period moving averages on the daily chart, which is kind of a bizarre outcome if you stop and think about it.
That is interesting. Mm-hmm.
And nobody will admit that they look at a 20-period moving average, but it seems to be effective. So that kind of takes away the idea that everything is self-fulfilling and an indicator is really only useful if it's everybody's using it and everybody knows that everybody is using it. Okay, to go back to this chart, so the first thing we had was the day before, we had a close right at the 20-day. And that pretty much tells you that the next day it's going to test it. And if it succeeded in testing it, as it did, you're going to be getting a new trend. Another thing that's interesting here is this channel that you can see. Now, this blue channel, which starts over before September. Yeah, right there. It starts there. Now, how did I start it there? Well, I can only start it there after the fact. In other words, after I have had a breakout above the previous down channel, which is in gray, very pale gray. This is called a standard error channel or a linear regression channel. I call it a LINREG channel for shorthand. And it's extremely useful because that center line is the linear regression. And we always tend to have a little bit of reversion to the mean in all prices. And so here, if you look on the right-hand side of this chart, after the big intervention bar, that big white bar in the middle with a blue line through it,
This one?
that's the day that the Bank of Japan intervened. After that, you see that those prices are clustered around the linear regression line. Very little variability away from the linear regression line.
So the limb rate is blue right here, right?
Right. Now the channel formed on either side of it is formed by taking two standard errors. And a standard error is just like a standard deviation, essentially. They're equivalent.
95% of the price
yes.
fall within.
That's right. It captures 95% of the price variation. When you have a price that breaks the channel, you have you know one thing, and that is that it is abnormal. That's all you really know. Because prices, 95% of the prices should remain within the channel, and as you can see, we had 3 weeks where they were perfect. They were right on the linear regression itself. Right. Any breakout below that channel is a breakout, and breakout is one of the 3 or 4 top concepts in technical analysis. I'm sure everybody listening knows that. This is one way of demonstrating it. Another way that I like, that I use in the afternoon reports, which we can look at in a minute, is the Bollinger Band. A third thing I use is the average true range channel, which is not on this chart either. So I have 2 things here. One is below the 20-day moving average and below the channel, a breakout below the channel. Another possibility would be the lowest low, there. Sometimes what I will do is I will draw a horizontal line right there, because breaking a previous intermediate low like that is also a sell signal, in this case because we're on the downside. So that's another thing.
I call something like that on the euro-dollar as well.
Yes, I do that sometimes. Now, up above, there are 2 other indicators there, and the top window is a thing called Chandy momentum. It's really a relative strength indicator. Chandy is a technical guy who rewrote the relative strength index formula to his way of doing things. But it's an oscillator that oscillates between 50% above and 50% below. When it's above 50%, the thing is overbought. When it's at minus 50%, it's oversold. And as you can see, for the past 2 weeks, it's been falling from an overbought position and a nice straight line downward, yes. Just below there is momentum, plain ordinary, plain vanilla momentum. This is another indicator that not everybody uses. I like it. In this case, it showed me that this uptrend, the one that's following the linear regression, was already running out of momentum while it was still going up. As you can see, momentum started. Yeah, momentum started to fall,
up, but it was falling.
That was falling. You got it. So that's already giving me a little bit of a warning. Plus, of course, then it goes down to the 20-day into the channel bottom. So I could see this signal change coming 3 weeks in advance by using momentum. That doesn't mean it was necessarily going to happen. I had to wait for the trigger event, which is the 20-day and the channel breakout, but I could see it coming. And that is useful to the listener, potentially, because it changes how much risk you're willing to take. If you know that there's a risk of a downside breakout and you're long the currency, you want to be able to know how far away your stop should be. And this is a case where you would have a small stop. There are other cases where you want a wider stop, like we have today. I had to set my stops very wide on today's report because, unfortunately, when we have a big move like we had today, the possibility of a bounce is very, very high. The trend isn't going to change. It's just that you have to set your stop quite far away to avoid getting hit, to stay in the trade.
It's on Tuesdays, right?
It's a pullback Tuesday.
Yeah.
But in addition, just any big move almost always gives you a counter move. And in fact, Javier, if you can take your cursor all the way to the left-hand side of the screen for the first blue line, the vertical blue line, that one. Okay, now see there's a big bar there, big down bar. Look at the next bar after it. Okay, you did get a lower low, but you also had a little bit of a pullback. That's pretty much what I'm expecting to happen on today's chart. Not on this one you're looking at here, but on today's chart.